Hello and welcome to our channel. In this video, we will discuss what is credit risk grading, why it is important, and what are the risks involved in it. So let's dive in.
What is credit risk grading?
Credit risk grading is the process of categorizing borrowers based on their creditworthiness, that is, their ability and willingness to repay a loan. Lenders use credit risk grading to assess the likelihood of a borrower defaulting on a loan and to determine the appropriate interest rate and other terms of the loan. The grading system assigns borrowers to different risk categories such as low risk, medium risk, and high risk based on their credit history, income, debt levels, and other factors. Borrowers with low credit risk are considered to be more reliable and are typically offered more favorable loan terms such as lower interest rates and longer repayment periods. On the other hand, borrowers with high credit risk are seen as more likely to default on their loans and may be rejected for a loan, or if approved, may face higher interest rates and shorter repayment periods. Why is credit risk grading important? Credit risk grading is an essential part of the lending process as it helps lenders to manage their risk and ensure that they are lending money to borrowers who are likely to repay it back. By assessing the creditworthiness of borrowers, lenders can avoid making loans to those who are too risky, which can result in costly defaults. In addition, credit risk grading allows lenders to charge interest rates that reflect the level of risk that they are taking on. Borrowers who are considered to be more risky are charged higher interest rates, as they are seen as more likely to default on their loans. This helps lenders to compensate for the risk that they are taking on by lending to these borrowers. Moreover, credit risk grading helps in the development of a borrower's credit history. When borrowers make timely payments on their loans, they are rewarded with lower interest rates and better loan terms as they demonstrate that they are creditworthy. Conversely, borrowers who fail to make their payments on time may face higher interest rates and stricter loan terms, which can help them to improve their creditworthiness over time. Overall, credit risk grading is an important tool for lenders and borrowers alike, as it helps to ensure that loans are only extended to those who are creditworthy and that interest rates and loan terms are appropriate for the level of risk being taken on. What are the risks involved in credit risk grading? Despite its numerous benefits, credit risk grading also involves some risks and challenges. One of the main risks is that the grading system may not accurately reflect the creditworthiness of a borrower. If the model is biased or uses inaccurate data, it may result in some borrowers being incorrectly classified as low risk when they are actually high risk. This can lead to lenders making bad loans and ultimately defaulting. Another risk is that credit risk grading may perpetuate existing inequalities in society. If the model is based on historical data that reflects discriminatory lending practices or other forms of bias, it can result in certain groups of people being unfairly denied access to credit. This can have a negative impact on their financial well-being and can contribute to the perpetuation of social and economic inequalities. Additionally, credit risk grading models may not capture all of the relevant factors that contribute to a borrower's creditworthiness. For example, they may not take into account a borrower's income stability, collateral, or the lender's ability to recover the loan in case of default. This can result in some borrowers being unfairly denied credit, when they actually have the ability to repay it back. Furthermore, changes in economic conditions or other external factors may impact the accuracy of credit risk grades. For example, a borrower who was considered to be low risk during good economic times may become high risk during a recession, due to factors such as job loss or reduced income. However, credit risk grading models often rely on historical data that does not take into account these types of external factors, which can lead to inaccurate assessments of a borrower's creditworthiness. Despite these risks, credit risk grading remains an important tool for lenders and borrowers alike. By understanding the potential drawbacks of credit risk grading, lenders can work to mitigate these risks and ensure that their grading systems are accurate, fair, and reflective of a borrower's true creditworthiness. Risk involved in credit risk grading. 1. Financial risks. Risk that occurs for loan clients due to financial distress. This typically entails analysis of financials. Financial risks are leverage, liquidity, profitability, coverage. 2. Business or industry risk. Unfavorable condition or adverse. Business situation will affect borrower capacity to meet the obligation. It includes size of business, age of business, business outlook, industry growth, market competition, entry or exit barriers. 3. Management risk. It represents poor management condition and also includes experience. Succession, teamwork. 4. Security risk. Risk that occurs due to poor quality or strength of security in case of loan non-repayment. It includes security coverage, collateral coverage. Support. 5. Relationship risk. It includes account conduct, utilization of limit, compliance of loan conditions, personal deposit. So this was all about credit risk rating. I hope you found this video informative and helpful. Also, if you have any questions or comments, feel free to drop them down below. We'd love to hear from you. See you in the next video. Thanks for watching. Banking and finance.